Hello, everyone, and welcome to our January 2023 investment webinar update. Today, I'm joined by Mike Parsons, who's head of sales for Foresight Investments. Just to give you a bit of background, Foresight specialise in infrastructure investing, so different slant on things, and Mike will hopefully be giving us a good overview, a macro update on where we are, but also really focusing on sort of the infrastructure side of things as well. Mike, thanks for joining us. Happy New Year to you.
Pleasure. Yeah, and to you, Mike, and to you. Let's fingers crossed it's a better year this year for investors than last year.
Absolutely, brilliant. Right, so Mike, I think you got some slides. Are you happy to bring those up for us?
Great. Yeah, thank you, Michael. Yeah, so our outlook for 2023, as I said, fingers crossed for all investors that it's better than 2022, which if you look at the historical data, that was one of the worst years for 200 years for investors, with both bonds and equities falling at the same time. So never nice to live in interesting times, but certainly not as an investor. You'd rather have calm and sort of predictable returns, but we are where we are. So looking forward to 2023, we see sort of divergence of fortunes continuing. Key messages are obviously we're going to see China, or we are seeing China reopen its economy. They've gone from a sort of zero COVID policy to basically having zero restrictions now. So that should be positive for the world economy, as it is really the factory of the world. So whilst we've had high inflation, with China reopening, that should hopefully bring down the price of manufacturers' goods as supply chains become more normalized. On the other side, they will obviously draw in more energy to produce goods and the things they manufacture, and also sort of could drive up commodity prices. So you've got disinflation of more production, but possibly inflation of more demand as well. But net, that's a positive for the global economy. The US economy is going to be a mixed bag. We expect the US economy to probably bumble along doing okay. It's performed pretty well this year, but as with here in the UK, we've seen much higher interest rates, and we think that will sort of choke off the economy at some point. Possibly the US will fall into recession. It is a very, very robust economy, so never really bet against the ingenuity and the work ethic of the US. But we do expect to see some weakness driven by tighter interest rates. UK and Europe, we've really been squeezed twice. So obviously we have higher interest rates, but also we're at the brunt of the energy price squeeze as well. That's been so painful for consumers and businesses over the last year. So we do think that with the exposure that the consumer has to shorter term interest rates via mortgages, then it's going to be a pretty tough time for European consumers. One of our concerns for next year is really around about corporate profits, and particularly for those companies that in the US that have high levels of exports. With a strong dollar, if they're selling products into the UK, into Europe, when they convert those sales back into dollars to calculate their sort of their profit numbers, the effect of the exchange rates is going to squeeze down on corporate profits. Plus, adding in, looking forward, the pressure that consumers are under, we do expect to see that we'll see an earnings recession for companies throughout the first half of 2023. We do think that if we have a recession, it's going to be unlike ones that we've seen in the past. Employment rates are very high. We've seen lower participation rates in employment markets. So we don't see a dramatic pickup in unemployment across the world, but we do see it really coming through as recessions in terms of corporate profitability, as I said in the previous slide. So yeah, with the rising rates, it will squeeze consumers, it will squeeze companies. So profits could be under pressure. In that environment, we think the areas that you should look at, infrastructure, the likes of power generators, road operators, school and hospital operators, should be robust. These companies have very predictable cash flows and incomes, and are not really tied to the economic cycle. So we do believe, and this is our advertorial, that infrastructure could be an interesting place to invest at the beginning of 2023. That said, stock markets and bond markets are forward-looking. They are pricing in already some slowdown in corporate profitability. And at some point during next year, we'd expect to see markets turn, broad stock markets turn, as they look through the noise of higher interest rates and falling inflation into an economic recovery in 24 and a bit further out. That said, our view is not to be wildly optimistic going forward, but to tread very cautiously and really look for robust, strong companies with visible sort of earnings growth, if you can find them.
Brilliant. That's a good overview. Thanks for that.
So let's just skip on to looking at our economic forecasts. So these aren't our forecasts; these are consensus forecasts across the market. It's a busy chart, but just have a look at the UK and the US numbers, particularly looking at the middle block, 2023. So what we can see on this chart in the dark green, where we say 6 months ago. So 6 months ago, economists were forecasting that that the US would grow by 2% this year, and the UK would grow by 1.2%. But wind forward to today, and those numbers have been revised down. So we're expecting the UK economy to contract by 0.8% in 2023, and the US to grow at a very modest sort of 0.4% over the course of the year. Wind a bit further forward, and economists are predicting that the UK will come out of that recession in 2024, but really anemic growth of around 1%, and the US below trend level of growth of 1.3%. So we're expecting a shallow recession, but pretty shallow recovery afterwards as well.
What's the main driver behind that, Mike? What's the what's driving the view that growth in the US and the UK will be below the Eurozone?
Principally, it's the rise in rates that you've seen in the UK and the US. The rates are higher here than they are in the Eurozone. And growth has been stronger in the US and the US and the UK than it has in the Eurozone. So it's just a bit of a rebase back from slightly higher rates in the past, so higher rates of growth in the past. But principally, it's just that higher level of interest rates, which are going to squeeze consumers that much harder in the UK and US.
Brilliant, thanks.
Similar charts here. What we're looking at is inflation, and whilst growth has been revised down in the UK and Europe, inflation has actually been revised upwards. So we're looking at 6 months ago, inflation was forecast to be 4% for 2023 in the UK. Now economists are forecasting just shy of 7% inflation. Obviously, the Prime Minister has promised that he's going to halve inflation, which would indicate it's going to be sort of in the range of sort of 5 to 6%. That looks quite optimistic. I think we'd all be very happy if it does happen. I do have some charts a little bit later that can give us some cause for optimism. But next year could be this year could be one of very weak growth or small sort of recession combined with high inflation. So that's I think in economic terms is called misery. It's not a great environment for society to live in. Thankfully, 2024 looks like inflation is forecast to get back towards the 2% target that central banks around the world have typically set themselves. So we don't want to be too gloomy, but it looks like we're in for a pretty gloomy period for the next year or so.
So not a dramatic change for 2024. Actually, you can see 6 months ago they were forecasting 2%, where we want to be, but actually around the 2.6% as of today. There's not quite so much of a disparity from what we can see for inflation this year. So they obviously think longer term that will drop down, but there must have been some more intermediate short term hits on inflation this year, which I guess you might talk a bit about.
Yeah,
in the
it's really
moment?
about power prices. So I
Right.
think the longer term expectation of the power prices is that they would fall towards their long run average, and that obviously makes up a huge part of the in sort of inflation basket sort of for the economy.
Excellent.
Just looking at sort of divergence of fortunes, this is just simply showing that we were much more optimistic coming out of COVID. Where obviously consumers had made some savings, that there was some sort of stimulus checks and the furlough payments made to people, and we're expecting that sort of economic recovery as we emerged from COVID. Then obviously we've had higher inflation. The Russian invasion of Ukraine has obviously pushed inflation higher and damaged confidence. And now we are where we are for 2023. So it's amazing how quickly things do change. And we will have to invest through that through that cycle.
Excellent.
Looking at consumer prices, really interesting figures here. So these figures broadly go up to the end of November. We're still waiting for December's CPI data to come out. This really does show how high inflation or how quickly inflation built within the system. Principally coming about, as I said, from Russian invasion of Ukraine. What is sort of encouraging is that you can begin to see those numbers in the Eurozone and the US have begun to roll over. And there'll be more data released later this week, which the market seems to be pricing that will be quite sort of positive for inflation falling. So we think we're going to be in an environment, a disinflationary environment, which broadly means high but falling levels of inflation. Still painful. Inflation is still running at sort of 5-6%, but markedly lower from its peaks. And you can see here that not everywhere has suffered the same sort of inflationary peaks. It's really been UK, US, and Eurozone.
But interestingly, when you look at this graph, you can see going back to 2007-8, which is the last time we had high inflation. We're not a million miles away from the peak that we had then. And actually, there was a fairly sharp drop then in the rate of inflation thereafter because of fiscal tightening. We saw obviously interest rates increasing then. So effectively, we can start to see a similar trend, hopefully, that as interest rates are going up and the tightening's getting harsher, that hopefully we'll see that sharp contraction, if you like, in inflation. And if we do, then hopefully we'll start to release interest rates later this year.
Absolutely. Yeah, very much that, but hopefully without too much economic damage. And I think one of the things I put at my first slide is that engineering a soft landing, i.e. a slowdown in the economy without pushing yourself into recession, is notoriously difficult, and that really is the challenge that central banks and governments around the world have to navigate. Just moving on, in the inflation story. So last year it was very much about goods inflation as energy prices skyrocketed. It seems that now service inflation is picking up rapidly as well, and this is a bit more problematical. Obviously, goods inflation can shoot up quickly, but it can come down quickly as supply chains open up and as energy prices fall. But services inflation, it tends to be more sticky. And that's because a greater proportion of that is coming through from wage growth, from labor costs. And obviously, if you have increased wages but not increased productivity, that in itself is obviously inflationary. And whilst product prices can fall, once you've been given your sort of your salary increase, it's never taken away. So if we have built-in sort of service inflation and wage growth inflation, that tends to be much more sticky for the economy and much harder to drive out of the system. Whilst none of us want to suffer a falling living standard through inflation, if we all collectively bargain for a higher salary but don't produce anymore, then you're building in sort of long-term sort of inflationary spiral. So this is the challenge that companies and governments have, is to try to maintain the goodwill, I guess, of employees, whilst we try and drive goods inflation out of the economy without building a sort of self-reinforcing inflationary cycle. So that really is a challenge and one to watch.
Is that why, Mike, that we could argue that there may be a softer landing in this recession? Because whilst this wage growth is probably going to make the recession a bit longer than anticipated, because inflation is going to be higher and interest rates have to go higher to try and curtail that, the fact that we're still seeing record numbers of employed individuals out there, we're not seeing mass redundancies yet. That obviously there could be some casualties. There still seems to be a real appetite for taking on employees, and therefore, as a result, we may not see as harsh a recession for that very reason.
Yeah, no, we would agree very much with that. And it's fascinating in that it's not just a UK phenomenon of high employment and a scarcity of labour. It's very much right across the developed world. So the US has the same issue, and the EU has the same issue. Japan's had the issue for 20 years. But it is, what scarcity of labor should provide that shallow recession that you mentioned. Clearly, more people in work, more people can spend. They are spending much more on debt interest payments, but we don't really see or foresee a dramatic pickup in unemployment, which is what you would typically expect to see in a recessionary environment. Just looking at interest rates, and obviously interest rates have had to be pushed up to get towards a more normalized level. When I was younger, if you could borrow money at sort of 5 or 6%, that was always seen as a bit of a steal. Obviously, the whole global economy has changed over the last 20 years. But we've been in a period of 20 years of low to very low interest rates, and they have had to rise to combat inflation. We're at 3.5% for base rate in the UK at the moment. Where the market is expecting rates to get to, look at this sort of blue line, is the bond market is broadly expecting interest rates to top out at the UK at around about 4.75%. So possibly another couple of interest rate rises to come in the UK. The number for the US is the US bond market is expecting rates to rise to around about 5%. But for investors, this is it's a key indicator for people to look at. And you really are seeing asset prices being reflected by the kind of the wrestle between bond markets, who think interest rates can possibly cut next year, and central banks, particularly the Federal Reserve in the US, who are saying we will keep tightening to make sure we drive inflation out of the economy. So central banks are kind of indicating they expect interest rates to rise to a level that's higher than the bond market expects. And that's why we see sort of more volatility in asset prices at the moment, as investors are sort of flitting in between those two sort of narratives and trying to work out which one will be right. What I would say is in the UK, the Bank of England seems to be a little less hawkish than the US Federal Reserve. I don't think that's necessarily because they think that they can drive inflation out easily in the UK. I think it's more along the lines of they don't think that the economy can take stronger, sort of higher interest rate rises as maybe the US economy can do. So obviously for those of us with mortgages, and I saw some figures today saying that there's going to be around about 1.3 million people with variable mortgages that come up to renewal this year. And those 1.3 million mortgages are currently at less than 2%, and they're going to have to refinance at a higher rate. So that will hurt the consumer.
And I think that's the other thing to point out, isn't it? That probably the other reason why we might not have such a sharp contraction in inflation as we otherwise might have had is that the impact of interest rate rises is delayed somewhat. Now, interest rate rises, they obviously say take a period of time to filter through, but more so when we look at where we are today, where a lot of people are fixed in at very, very low interest rates. Yes. Whereas in 2008, a lot of people were on tracker mortgages because of the circumstances the mortgage market was at that time. And so obviously there seems to be that delayed impact. And maybe, as you said, if there's 1.3 million homes that are going to come up for renewal on a mortgage, that this is the contraction period that we will see over the coming 6 months. So it looks from what you've said that forecasts are suggesting Q1 of this year, we should hopefully see the majority of any rate rises in the US and the UK.
Yeah.
Probably hold for a while just to make sure inflation is on its way down. And then when the various indicators come through, possibly start to reduce interest rates with a view to try and get the economy going again later this year?
Yes. I'm
Fingers
smiling in
crossed.
that. Yeah, there's a lot of debate whether rates will fall later in this year. One other point I would note is that rates probably don't have to rise as high as they did in the past, purely because the stock of debt that is outstanding is so much higher. So by raising rates on a higher stock of debt, you're actually removing more sort of cash and discretionary spending out of the economy, which in itself should drive out inflation. So yeah, very much agree with you. Want to leave everybody with some much more positive news though. So just looking at energy prices. So this is just a 1-year chart looking at Brent crude. So this is the oil price that you'll see sort of quoted on the news and determines petrol prices and fuel prices in the UK. This is a 1-year chart. You can see that prices have fallen back down to the level we were at the beginning of last year. So we've taken out this massive spike that caused by the Russian invasion of Ukraine. And obviously, energy prices are a massive component of inflation. So, you've seen prices fall from $120 a barrel down to 80. So, this should provide headroom for inflation to broader inflation to fall. One other point I would note here as well is that the G7 introduced an oil price cap for Russian oil, for Urals Russian oil. That cap was at $60 a barrel. Russian oil is currently trading. I'm going to take the Bloomberg figure that I saw today, but it's trading on Friday at $38 a barrel. So that's really going to damage Russia's economy, as they can't even sell it at the price cap, and they can't get nowhere near the kind of the global market price for oil. So they are typically, I think, believe selling their oil to China and to India, who are clearly driving a hard bargain for Russian oil as their typical Western markets have been closed to them. But
so just on that point, so a couple of things there. Firstly, obviously, we've seen the oil price come down. And I personally think that it feels like there's been a recalibration across the globe. If India's taken up, say, 30-40% of the oil that the Eurozone was taking, then obviously wherever India was originally getting its gas and oil from, well, that's coming to recirculation with the rest of the globe. So there's a sort of a recalibration of where everyone gets their oil and gas from, and things have settled down a little bit more. Is that having an impact on the oil price, would you say, or is it not related to that?
I think it is. Clearly, with the change in sort of consumer and corporate behavior in that we've all turned our thermostats down. Thankfully, we've had a very mild winter in Europe. And that's obviously pushed down demand as well. So I think it's a mixture of many different things have sort of come together to help drive oil prices down. This is, though, very positive for the economy, and hopefully positive for inflation.
Well, the other thing I saw the other day was that petrol prices were around 15p higher than they suggested they should have been in December, based on the Brent crude oil price. So I think there's probably going to be mounting pressure coming on the pump prices to try and bring that down. If obviously we're trading back at prices pre-war. So it'd be interesting to see how that rolls out over the coming weeks and months as well.
Indeed, we at Foresight, we are free market capitalists, so we'd expect the mechanism of competition to drive prices down for consumers. If I move on one, this is a 5-year chart looking at gas prices, so natural gas prices. Similar story. We are back to the level we were a year ago. Clearly, that is elevated over the longer term sort of 5-year picture, but a dramatic fall in prices. This is a change in consumers' behaviour, say turning thermostats down, and what we saw back in the summer, those two sort of peaks, was European governments largely just filling up their gas reserves because they knew they needed to get the gas reserves filled up for this winter, and broadly paying whatever price it took to get those reserves up to kind of up to full capacity. We managed to do that in the summer, and subsequently we've seen prices fall dramatically. And gas prices, electricity prices are typically driven off of gas prices, so this should be really positive for consumers and for businesses as prices, I'm not going to say normalize, but certainly fall back to pre-invasion levels and hopefully stay there. And we have, as you mentioned about changing in suppliers, we've seen the UK and the Eurozone do long-term, so 25-year plus deals with the likes of Qatar and the US to import liquefied natural gas, and basically just cut Russia out of their supply chain entirely. That's not going to come back. Nobody can rely on Russia as a partner. So we are really going to change our suppliers for the long term and for the better.
And so that should give more stability, hopefully, over the long term.
Yeah, I don't have enough details about the prices that are being paid for the gas that we are importing, but yeah, you would certainly assume that the US is going to be a very much more stable partner to Europe than Putin's Russia.
So I think that's really positive, isn't it, to see that whilst the main driver of inflation, obviously you talked about the inflation being baked in by wage growth within service industry, but the main driver of inflation that we saw through the majority of last year seemingly has dissipated somewhat. And we just need to hopefully now see that inflation wash out over the next 6 to 12 months. Hence why I guess the forecast for 2024 is that inflation is far lower than it currently is.
Yes, absolutely. I mean, we would also include that a lot of the quantitative easing that happened over the last 20 years and certainly through the COVID period. Obviously, that's created more money, which has in itself has created inflation. But yeah, the big spikes that we've seen over last year were really clearly caused by higher energy prices. So it is a positive.
Brilliant.
So if I just summarize, so this year could quite likely be very different from last year. So we're expecting 2023 for inflation to moderate, but growth will be weak. 22 we actually saw strong inflation and inflation picking up, but growth being quite strong. We expect to see central banks likely towards over tightening interest rates to just make sure that they've driven inflation out of the system. Central banks are willing to sacrifice some growth and possibly push us into recession, just to make sure that the inflation doesn't sort of re-emerge back into the economy. As I said before, expect the employment markets to remain relatively tight, irrespective of the recessionary environment. We expect to see some weakness in corporate earnings, and that will likely create some volatility in stock markets, certainly in the first half of the year. And as infrastructure investors, that's actually got a positive environment for our asset class. And the demand for infrastructure, it's critical for the operation of the economy. And the demand is non-cyclical, and typically you have very, very strong counterparties, typically governments that are paying the bills for the use of and availability of infrastructure. So that should be very stable for the core parts of portfolios in what could be a tricky first half of the year. And just to finalize, just on decarbonisation. So as we aim for net zero emissions throughout the developed world and throughout the entire world, plus the geopolitical situation driven by what's happened in Ukraine, we are really expecting to see continued growth and a drive into investments into infrastructure and into renewable energy and energy transmission. So we do think there are lots of interesting investment opportunities out there for investors who can look through the noise of what's going to be a tricky first half of the year.
Brilliant. Well, look, Mike, I think you've summed that up absolutely brilliantly. Really appreciate you coming on today. Hopefully that gives everyone a really good understanding of where we think 2023 is going to go. Please tune in next month for our next investment update. But for now, I'll say goodbye to Mike and look forward to seeing you all in a month's time. Thanks very much.
Thanks, Mike.